I'm here to make financial planning great again, okay?
So bad. Hey everyone, I'm Andrew. I'm a CFA Charterholder and CFP professional, and I'm also the owner of Lever Wealth Management, which is the financial advisor for people who scare financial advisors. And what I do, since I've worked with high net worth and ultra high net worth investors for several years, is I take those learnings from the thousands of iterations and I bring them to you so that you can apply them to your own situation. And today I want to talk about the fact that Trump won the presidency. Again, how does that affect how you should view your financial plan? It's a bit of a tough question, and I'll preface by saying I really don't care about your politics, and I'm not going to bring my politics into this. I'm simply using this as a framework to say, hey, are there some macro decisions that should be considered in light of this change? And so there are two things in particular that I want to talk about. But first, I want to back up and say a retirement plan is primarily a function of your assets and how quickly they grow, your spending and how quickly it grows, and the time frame of which you'll be spending the money. Those are the determinant factors in a successful retirement. When I say success here, I'm meaning it in a monetarily successful, like you don't become destitute. If those are the primary determinants of success, how does a Trump win affect those determinants of success? And there are two in particular. One, taxes. Two, inflation, right? So the taxes are going to affect how much you spend. The inflation will affect at what rate that spending increases. A Trump presidency, in my opinion, is inflationary. I felt both Trump and Harris would have inflationary presidencies. Feel free to disagree with me. Why do I think that? A couple reasons in particular. Trump really likes tariffs, and he's been unabashed about this, and he implemented them in his first term as well. And so when you implement tariffs, we can argue whether it's good or bad for the American people as a whole, but one thing I think is difficult to argue against is that it is inflationary. Why? If right now the input cost is lower because a country with lower GDP and nominal income is producing a good or a service, and we bring it here, right, to create it domestically, how do we enforce them bringing it here? Well, we create a tariff, right? So they can't bring the good in. Okay, when you do that, and you're a company that creates a good, your input costs just went up. Are you going to eat that as the company, or are you going to, as much as you can, pass it through to the consumer? The answer is you're going to pass it through to the consumer, and depending on the type of company you are, certain companies, it's much easier to pass through inflationary increases. Procter & Gamble is a good example. Crest toothpaste, you're not going to notice that much if it goes up at the rate of inflation or even more, and you're going to buy it regardless because it's a staple good, right? The gas pump you see much quicker. So tariffs are inflationary because they increase input costs, and those tend to get passed through to consumers. On the tax side, this is a lot more interesting question, and there's a short-term answer and a longer-term answer. The short-term answer is if tax rates go down, either A, through extending the Tax Cut and Job Act past the end of 2025, or through a lowering of the corporate tax from 21 to 15, abolishing the federal income tax, which that'd be interesting to see actually happen. The short term, it should spur outperformance of GDP. If people have more money, they're most likely going to spend it. And if they spend that money, it increases GDP because about 70% of our GDP is from consumption. The problem here is that when you look at fiscal multipliers, which all that means is, hey, if we give some type of fiscal stimulus, either through lowering taxes or other fiscal measures, what's the multiplier on that? If we give $1 tax break, do we get $1.50 in revenue? And typically what happens is those who are more likely to save the money have a lower fiscal multiplier, which makes sense, right? So if the tax cuts affect those at the lower end of the income tax brackets, there's a higher multiple. They're more likely to spend it, whereas those who are in a higher tax bracket are a little more likely to save it, all else equal. So it depends on how the tax cuts are enacted. Historically, broad tax cuts have not given a very high fiscal multiplier. Now, it could be that increases spending such that it increases tax revenue. But if that theory is wrong, the problem is all you're doing is increasing the fiscal deficit. I'm getting to a point. The US has $37 trillion in debt right now. About 20% of it's owned by the US Treasury itself. So it's, me owing money to myself. Well, I can cancel that debt. That's not a big deal. But our debt to GDP is about 120%. Wharton did a really good study on how long can we continue at this rate. And it was about 20 years before there's actually some really big issues with the possibility of default. What's my point in this? I'm not going to assume in my clients' financial plans that tax rates go down over a long period of time. The United States has about 120% debt to GDP. That's on the higher end. It's still okay, but it's on the higher end. If we lower tax rates, there's a possibility of us increasing that deficit. Now, there are a lot of levers you can pull. I understand that. But from a planning perspective, do we want to plan aggressively and hope for the best? Or do we want to plan conservatively? And you know what? If things go better than what we had modeled, fantastic. I would rather plan conservatively. So from a tax perspective, I'm at minimum going to say tax rates go back to what they were in the Obama era. It may even be worth modeling. What if tax rates jump in 15 years? Furthermore, from an inflation perspective, I think it's prudent to increase your base inflation rate because taxes and inflation, they're interrelated. If we have such a debt load in the US economy, we can end up causing inflation over a long period of time. We've seen that with other countries over the years who have gotten into too much debt. Furthermore, if we're spurring economic growth, inflation is most likely going to stick around for a while. I could be wrong on all of this, right? I'm prognosticating the future. However, when we look at retirement planning, there are some things that we can model in a Monte Carlo analysis. There are some things we need to do a scenario analysis for. And I've talked about this in other videos. Change of tax law is a scenario analysis. Longevity is scenario analysis. Inflation is usually modeled in a Monte Carlo when there's 1,000 iterations done. But if you change the base rate, it's going to change the distribution around that rate as well. And so when I look at a Trump presidency, in my opinion, I say there's most likely going to be fiscal stimulus, which is most likely going to keep inflation around for a while. So it would make sense. I shouldn't be assuming inflation's 2, right? The terminal rate that the Federal Reserve wants to see, or the neutral rate rather. Maybe I should be looking at it at, up 50 basis points, or the historical average of around 3. And then when I look at tax structure, should I, for certain clients on the higher net worth range, be assuming your tax rates are going to go up in the future? And that's going to have a variety of impacts on how we plan. It's not black and white. And I think the long-term impact from that are increased taxes, increased inflation. Unless in the interim, there are some changes made in the federal government as a whole. So that's my 2 cents. Take it for what you will. I hope you found it helpful. Until next time, see y'all.